again, welcome back to the Hawaiian Trader. Welcome back, YouTube. We're diving into the real basics on selling call options. Thanks for joining me. Now, if you didn't watch the first video, which is how to buy a call option, I highly recommend it. It's going to talk a little bit more about the theory of why this video even exists, and it has to do with the fact that what people claim to be the basics is not really the basics. This video is the real basics on how this works. We're talking about selling calls, folks, so let's dive into it. Let's first of all get into that concept that we finished off with in our last video, which is the contractual rights and obligations. Technical term and technically the basics, right? Let's break that down. What we're talking about is contracts. So remember the relationship of contracts. There's typically two parties on each side of a contract, and they have different interests. I want to talk about selling contracts. Now, why in the world would there be a call option in the options market that could be sold? Well, let's talk about, first of all, what is the ability that a seller of a call option has? Well, that's very simple. What they have is the ability to deliver shares. Now remember, hopefully you watched video 1, part 1 on this, because although it says that they have an obligation to deliver 100 shares, remember we're talking about contracts. So that's something that's happening in the background. We're not actually delivering shares. The only time you would have to actually deliver shares is if the individual on the other side of the contract exercises their contract and actually wants to buy 100 shares outright. Now, to understand that, make sure you watch video 1. Let's get into this. So, we have an individual who potentially might want to buy 100 shares of stock. It's too expensive, so they buy the call option to control the asset rather than own the asset. Now, somebody has to sell this to them. Somebody has to say, if you might be interested in the future and maybe buying 100 shares, somebody has to deliver those shares. Now, typically, this would be the market. So if I went out in the market and I bought a call option and I exercised that right, my contract, the market has to give me 100 shares. That's my right with the call. Now, when you sell a call option, which is what this video is about, you're taking the other side. You are now saying, hey, market, I will be the one responsible for the shares. I will be the one to deliver those shares. Now, this doesn't mean you have to have the shares. It means you either A, have to have them, or B, just the money to have them. So when you take on that obligation of potentially delivering 100 shares, in essence, what you're doing is you're taking the place of the market. You're basically saying, I'll be responsible for those shares to deliver them if I need to. And the market says, okay, well, if you're willing to take that on, we will pay you a fee. We will pay you a nice little fee for the responsibility that you're taking. Now, it's important to remember here that when I say they're paying you a fee, that's all you can make. So whenever you sell options, this is an important concept to remember. Whenever you sell an option contract, it is a fixed amount that you can make. There's only so much money you can make because the market's only paying you that small little fee for the risk that you're taking. So you have to first, before you decide to sell options, decide, number one, would I be interested in this little fee? That's number one. Number two, you have to think the opposite of a call buyer. Or what does a call buyer translate into? A stock buyer. So what's the opposite of a stock buyer? Stock buyers buy shares because they think the shares will increase in value, therefore increasing the value of their investment. So that means the opposite side would be down. Somebody wants those shares to actually go down. Now, I know this is crazy because, once again, here's another one of these money concepts, or what I call wealth character, that we don't get. Who in the world wants stock to go down? Who in the world wants investments like this to fail? Well, remember, there's two sides to every investment. Remember the contract? So one side of the contract is somebody who wants to buy shares because they think it will increase in value. But somebody on the other side says, I don't think those shares are going to go higher. Therefore, you're going to buy a contract that will have no value because the shares are not going to go higher. They're actually going to go lower. Now, when the buyer pays for that call option, he is paying the call seller. So to have the right to buy 100 shares, they have to pay somebody to give them those shares. So one of two things are going to happen. The stock's going to go higher, and the buyer of the call could potentially win some money. Therefore, the seller of the call may have to deliver those 100 shares, or at least the value. Or the stock goes down. If the stock goes down, the call buyer who wants the shares to increase will probably not be buying the shares because they're going down in value. But that also means that the option that they purchased has no value, and the person that they paid gets to keep all of the money. So this is a very interesting concept. I like to call it being the house or being the bank. You see, for every opportunity that's out there in the investment world, somebody has to be willing to buy an investment, and somebody has to be willing to sell them the opportunity. Now, that concept is universal, and it is in every single investment that exists. You don't understand it, and maybe you didn't know it until this video, because again, these things, these games, these investments were never designed for you. They're designed for Wall Street, and they're designed for banking. But what this allows us to do is it allows us to jump in at a very low level and get involved as the bank or the house and sell investments to buyers, which is exactly what Wall Street does. So, I love the concept of buying call options if you're optimistic about performance. But if you're ever in a market condition where you're skeptical on market performance, you don't know where the market's going to go. Or maybe you're in a market condition like we have right now where I don't know what it's doing. It doesn't really have real strong direction anywhere. It's a great opportunity to start selling things to people. Hype up people and tell them the market's going to be great. You want to get in now, and sell them those opportunities. That's what Wall Street does, and that's what selling call options are. We want to be on the other side of the game where we're selling opportunities to individuals that will probably fail, and therefore we get paid. Sound an awful lot like a bank? Sound like Wall Street? That's right. Options give you the ability to play both sides of the game, and selling is a concept that everyone has to understand. Whether you're buying or selling, you need to understand both sides. Remember to watch part 1 of this, which is called Buying. But thanks for joining me. Can't wait to see you next time. Take care.